Was today's end-of-day rally enough to extinguish this nasty sell-off that we've been getting the past couple of days? That's the million-dollar question that we'll look to ask and answer in today's episode of the Midweek Market Update. As always, check out the links listed down below in the description, hit the thumbs up button and subscribe if you've not already done so, and stay tuned until the end of today's show. I've got one additional trade idea to share with you that you won't want to miss. With that said, let's jump right into the charts. So we're actually going to start tonight on the SPY weekly time frame chart because I want you to monitor into Friday's close whether or not we can close in the previous weekly range on the weekly time frame chart, because what that would ultimately imply is if the answer is yes, we get some sort of weekly green-bodied hammer down here, and it begs the question, is it time to see a counter trend rally in the context of this new and established weekly downtrend, right? We certainly still have high, low, and lower low, but if we can produce a hammer which has failed to close underneath the previous momentum red bar's low, then it begs the question once again, up and over that hammer high on the weekly, maybe we're looking for a little bit stronger of a counter trend move into next week. And once again, the target would be the bottom of the double inside bar range from, what would that be, 3 or 4 weeks ago now at this point in time. We can see that level very clearly if we move on down to our daily time frame chart now and have a glance at the levels. Clearly, it's the backtest of this, which is also on the daily chart, the double top neckline. And that number is going to be at 443.25. So again, this is a stretch of the imagination. We're not talking about this into the end of this week, but if we can close back within the previous week's range, and just as an FYI, the last week's close is right here. So any closes up and over, let's just roughly call it our level at 431, do set up a weekly green-bodied hammer, which is definitely worth paying attention to. So that's first and foremost from the higher time frame perspectives. The reason we're talking about the possibility or opportunity for a counter trend move, of course, is based on today's daily close. Look at the hammer that we got, the long lower wick suggesting that at the lows, the sellers were unable to really materialize down there and the buyers actually made a stand into the end of day. But it goes further than that. It's not just any stand, it's not just any rally higher. We actually close back within the previous bar's range. So once again, if sellers are making true progress here in the downward direction, don't get me wrong, we're still very much so in a daily downtrend. We just produced a brand new intraday lower low. I'm not arguing that we're going to rally to the moon and set a new all-time high, but it begs the question, if stronger sellers were still getting involved dead on the lows of this overall move, would they have allowed for a rotation, a close, back within the previous day's range? The answer to me would seemingly be no. So let's not forget about the trend count, right? We have highs, lower highs, and along the way lows, lower lows, lower lows, lower lows the entire way. So even if we do rally on the daily time frame chart, is there not an opportunity to be up and over this hammer high? Again, 428 is the level. We'll see that more clearly on the hourly chart in just a moment. If we do rally, is that big of a stretch of the imagination? Probably not for a retest of 436. The reason 436 also gets very interesting is because that technically is the weekly double top neckline, right? If I scrunch this chart out and give you a little bit more perspective here, if this is your weekly double top, a retest of that neckline brings you to the bottom of the gap on the daily time frame chart. That's 436 that we were just discussing. But it goes one step further than that, right? Let's take a look at our alternate set of analysis here. This involves trend lines, and you can see the sketch of the head and shoulders. We'll talk about that in a moment. But from the October low, touch number 1 here, we are at the intersection of the longest time frame trend line that we have, as well as the counter trend. If you were to consider this bull flag consolidation from this perspective, we're at the crossing of those two trend lines. So again, with a long lower wick on today's session, a hammer candle, closing back within the previous day's range, I'll go back to our levels in just a second. You'll see that we bounced off of the lower bound of this week's expected move. Is it not logical that a back test of the head and shoulders neckline could also be on the table? And that's roughly that same area, right around 436. So that really captures my attention if we're going to see a counter trend move here up and over 428, which would be the high of today's hammer. If I zoom back in a little bit further on this, I don't want us to get lost here though. The measured move of the head and shoulders breakdown certainly would suggest that we have further to fall here after a potential lower high is set. The target of the measured move would suggest somewhere around 411. If we scrunch this up a little bit, does anybody remember what this is, right? This is the GFR. If you know what GFR stands for, drop it down below in the comment section. We can have ourselves a laugh. But back down to 411 is really not all that far off of what the updated summary of economic projections would state from the Fed that we got last Wednesday, right? The SEP prices the SPX at roughly 4,200 with the updated projection for the median rate in 2024 bumping from 4.6 to 5.1. We had the interns do the math over the weekend, and 4,200 is ultimately the number. Very precise, I know. Let's take a look at the default set, and once again, you can see there's your lower bound of this week's expected move. We're coming towards this prior structure. We're not all the way there yet, but the close back inside of the previous day's range, to me, is the biggest tell down here at the very bottom. So I want to be very clear, and I think at this point I have been, this is a counter trend move in the context of an existing downtrend. What would it require for a stronger daily reversal to really unfold? You would have to make some sort of move to here, pull back for a higher low, in which case we become neutral on the market. Then you need to break for a move over 443.25 to prevent the ideal weekly lower high, right? So there's a lot of work to be done on the bull side if a stronger reversal is going to unfold. It just doesn't appear to be in the cards. Once again, we're talking about a counter trend move in the context of a downtrend. The last thing I want to show you here on our daily time frame chart is the anchored VWAP band, just because we are starting to support a little bit at the secondary cohort of potential buyers. If we scrunch this out, remember we talked about these are the AI mania buyers in the upper VWAP cluster, and these are longer duration buyers who are getting involved off the October low, pivot high, pivot high, pivot low, right? So we just supported off of that yellow line, and once again, this is also confluence with your trend line. And to me, it would seem as though, again, I know I sound like a broken record today, but counter trend rally in the context of an existing downtrend would be fairly likely at this point in time. Let's take a look at the hourly time frame chart, because this does a great job of ultimately illustrating where we want to get involved. We can walk through some paths as we walk forward into the end of this week. First and foremost, right? If there is going to be any sort of up move, it needs to be generated up and over 428. This week has not necessarily been easy, but I think if you ask yourself the question, who is going to get hurt the most, that's been doing a really great job of illustrating how we should be thinking on the open, right? Monday was a little bit of a crapshoot, just noting, oops, really weird zoom there, apologies. But Monday's a little bit of a crapshoot moving higher. So into the end of day, great. This consolidation was looking good for the buyers. We squeeze into the close. The fact that we opened up underneath that consolidation means that the buyers are the most likely to get hurt on the open, therefore the shorts have the upper hand. Into today's open, right, we open here, we open inside of the bear flag consolidation from this little breakdown from the afternoon, so technically the bears are still content. If we were to have opened above 428, it would have increased the odds for a squeeze. The fact that we opened inside keeps the bears content. Even better would have been underneath, but obviously we break to underneath out of an opening range. Here's where things get interesting. We close the gap, and then what happens into the afternoon? We do see a rally. We pull back off of 428, and now we're opening, or we actually closed rather right underneath that bearish consolidation. So into tomorrow's session, I see it being quite clear. If we open in here, I think that the shorts start to become nervous, because these shorts, if they're still hanging on, are like, oh my goodness, why did we just see a big breakdown and we're not getting paid? Why am I back to break even after a full day of breakdown, right? So that does not feel good if you're a pre-existing short from this bubble right here. If you're a short down on the lows, then good luck. You've probably already been squeezed out. All it's going to take is a move up and over 428, and I think you could see SPY trading up towards 431s, and then we'll continue to walk up our levels. We have 433.65 coming from the spike originally that was last Thursday, right? And if we can get above that, we're talking about 436, and that is ideally where the daily lower high gets set, right? So that's the upward path, and again, that really hinges on opening inside of this range here to make these sellers nervous, breaking over 428 to start to squeeze those sellers out, and bring in new money buyers who are like, okay, we are finally starting to see a little bit of an oversold rally. How do you want to get involved on that? That's really up to you. If we open and consolidate in here, you could technically take the first break, noting that these shorts will likely squeeze. The more responsible trade is waiting for a higher low over 428 and then walking up your upside targets. You could also wait for a higher low over some sort of upward sloping VWAP based on the intraday, either Thursday morning or Friday morning. If we open underneath 426.50, I don't think all hope is lost. This consolidation kind of keeps us, this would be neutral for the buyers who tried to get involved on this rally. So if we're opening above, the level's 425, I believe, yeah, 425 right here. If we're opening above 425 but below 426.50, the buyers hang on to a thread of hope, but in the context of this downtrend, I think it'll be fairly difficult to have that momentum continue unless we're clearly making strides up above some of these key inflection points that we've just discussed. Obviously, the nail in the coffin would be falling underneath 425, now puts all of the buyers who bought into the afternoon consolidation, here it is actually on something, let's go down to a 5-minute chart here. All the buyers who got involved into the afternoon consolidation from today's session start to become underwater, right? If we zoom in here, you can clearly see there's your 425. You want to keep these buyers content, anyone from this pullback, anyone from this pullback. If we can hold up over this low, that to me would say, okay, we're at least neutral, maybe with the opportunity to become a little bit more bullish for a counter trend move over that 426.50 to begin the rotation and squeeze over 428, right? So something that does this, then this is the trade that I will primarily be looking for, the higher low over 428. If we do continue in the downward direction, I think that this is kind of like a kiss it goodbye situation. I'm not necessarily sure that I want to participate dead on the lows. Sure, we did get a technically counter trend move today, and there's the possibility that yes, this is going to be your next hourly lower high, but getting involved dead on the lows of the expected move here after a well protracted move on the daily time frame chart, hourly time frame chart. We'll also see this in the supporting evidence. The market internals were really not all that strong in the downward direction here. It feels like an exhaustion move on today's session. So with all of that said, I think you know where my head's at into the end of this week. You know the levels that I'll be watching. Let's take a look at some supporting evidence. Market internals are always Exhibit A. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. For the most part, does this agree with the analysis thus far? I would say yes. Obviously, Tuesday is the aggressive breakdown with volume reads getting substantial underneath negative 300 million. Net flows on the week are not yet substantial, trading at negative 291 million. Remember that 500 million is the threshold, positive or negative. If we look at the advanced decline line, Tuesday gets the worst. If we look at the cumulative builds, I think that this really speaks for itself. But what I want to discuss specifically for tomorrow's session is look at the internals on today's move, right? Even as we're breaking down aggressively into the afternoon session, breadths for the most part remained positive on the morning session. Technically, we opened higher near trend higher zone and had to battle back down to the zero line, and into the close we actually bounced off of the zero line for a positive close. It's not great, and again, definitely moving lower and definitely deteriorating here into the afternoon, getting better into the close, right? But it just would speak to, if stronger sellers were getting involved, you would have seen Armageddon style breadth throughout the duration of today's early morning down move. Same thing with the cumulative tick, actually building positive on the morning session, flipping negative slightly and closing nowhere near substantial, right? Substantial reads in the tick on the cumulative into the close breach negative 5,000, which once again speaks very clearly to Tuesday's damage. But for today, it seems as though the selling from an internal perspective, exchange level perspective, has subsided just a little bit. Exhibit B is always the market profile. If you're not familiar with this screen, check out the video tutorial in the top right hand corner. For the most part, what's going on here with value areas and point of control on Tuesday. Value and the point of control definitively shift lower with price, which once again, paired with the bearish internals that we were just looking at, make total sense. On today's session, we repair the poor low, and then what happens with value and the point of control? Even as the Armageddon style sell was unfolding early on in the afternoon session, look at where value winds up and look at where the point of control winds up, unchanged from the previous day's session. So value tried to remain unchanged. It's slightly lower. I'll give the benefit of the doubt. There's a slight lower high here, and there's a slight lower low here, but for the most part, it's unchanged and mostly within the previous day's range. Value was unable to progress in the downward direction underneath the Tuesday range. So once again, this would sort of speak and tell me that, hey, participants are unwilling to now be transacting at the bottom here, and it seems as though value has finally been established in this area. If we start to break up and over today's high of day, which is a mechanical level, notice that the high of day is the same as your prior value area high. If we can take that out, that's where once again, I think that you get a little bit of a squeeze from any shorts who are still holding on, who are initiating in this segment over here. So jumping back on over to the platform to evaluate the weekly performance of our sectors reveals that the energy sector, XLE, is up the most, leading the charge here, so to speak. Sorry, no pun intended. I'll stop with the jokes. Up 3.46%. And at the bottom of the barrel, we have the utility sector down 4.43%, really taking a beating. And this is fairly interesting because, as we know, utilities are D for defensive, and energy is a really lightweight sector. It's not heavyweight by any stretch of the imagination. The XLK is the heaviest weight risk on sector, and we see that down roughly 1% on the week, just beating out the S&P itself, which is down somewhere around 0.75 of a percentage point. Let's take a look at the structural charts themselves. You'll see that energy is breaking back into this range after trying to get a retest lower high under 90. That does strike me as look below and fail, and the target over time should be the top of this prior range, around 93.50. That would be slight upward pressure into the end of this week. XLI, what's going on with industrials? Notice that we did not produce a bar-to-bar lower low, and we do have buyers stepping up near the lows of today's session. If this does produce a counter trend move, we're looking for a rotation into 103, then the possibility for a daily lower high to be set. This is really not bullish by any stretch of the imagination, but it would speak to the counter trend rally that we're talking about over in the S&P. So here's the utility sector, which just got obliterated, blown out of the water over the last two trading days. Just, I mean, there's no words for this one, really. Obviously, it's bearish pressure. It's a lightweight sector, and because of its posture being D for defensive, it sort of is a bit of a head scratcher. Like, okay, if people are chasing yields, moving into defensives, why is this blowing up, so to speak, so badly? It speaks to volatility, big volatility in the market, and people not sure of the posture that they want to basically assume. So that would be the takeaway from utilities. It speaks to volatility. Utility specifically speaking to volatility, and we'll see that in the VIX in just a moment as well. Here's the real estate sector, obviously extremely rate sensitive as rates break to new not all-time highs, but recent and like multi-year highs. Obviously, real estate continues to fall off of a cliff here. It is concerning for these lower lows underneath the last major inflection points. Remember, when it's chopping around in a range, not a big deal. Doesn't really matter so much because it's such a lightweight sector, but this lower low is definitively more bearish pressure for our market. Let's take a look at the consumer staple sector, because once again, this is classically D for defensive, and just like utilities, it is blowing up this week, falling off of a cliff from a structural perspective. Big time new lower low, even if it does make a counter trend rally. This speaks to volatility and uncertainty from a posture perspective as the market is pulling back, which really opens the market up for further capitulation via full-blown correlation to the downside, right? What I mean by that is when these things are getting beat up, when people are not rotating into the defensives, there is no cushion for your S&P 500. As soon as your XLK sees a week that's down to the tune of 4.43%, it's duck and cover. Obviously, everything's going down with the ship. Next up, let's take a look at the XLY, what's going on with the discretionary over here. Made a new lower low, but closed back above this interesting level we had at 158. So monitoring for the hammer high. Again, still the context of an existing downtrend here, weekly downtrend, lower high, and a lower low, just looking for a lower high to be set on the daily, potentially underneath 163.25. Once again, this would speak to the possibility for a counter trend move, but not necessarily a big time reversal to the upside. Here's the tech sector, same commentary basically. Breaks to a new lower low, we can afford a lower high being set. Where's that lower high? Ideally, somewhere underneath 166.50, right? A rally that gets us back to here, retest at the bottom of the range, maybe a full gap close, because technically speaking, there's a little bit left there, but a lower high up against 166.50 would be beautiful for continuation of the daily trend in the downward direction. But once again, to get there speaks to counter trend move into the potentially end of this week, right? XLF, also an interesting one, finding a little bit of a hammer candle and closing back within the previous day's range, right on the low of the previous day's range. But I wanted to leave this a little bit further scrunched out so you can see the big failure here, specifically on the Tuesday breakdown, to hold the weekly higher low. Remember that this was the all-important level we were watching at 33.65. Obviously, on the Monday session, an attempt for a hammer, right? It was the saving grace. Finally, after this big sell, all we needed was a move over the hammer high. It never came. We made the lower low on the weekly time frame chart. This has a lot of work to do if there's going to be a stronger reversal. Now, there's no longer the opportunity for some sort of daily double bottom to produce your weekly lower high if we were to have gotten up towards that neckline. Obviously, that as a situation has been wiped off the table. So, sure, a little bit of a counter trend move, but even now, a lower high is threatening at 34.20 on the backtest of this area right here. Next up, we've got the healthcare sector. D for defensive, but second heaviest weighted sector by market cap. Look at the look below and failure from the sellers to close near the lows and underneath the level at 129. Once again, what does this speak to? Even if this just wants to cool off, it leaves the door open for the XLK to start to outperform and possibly see the counter trend move. It's not necessarily that I would look at this bar specifically and say, oh, great, we have an XLV hammer. We need to go long over the top and look for the counter trend. No. It just would speak to neutrality in here, preventing downward pressure, being the second heaviest weighted sector on the market as a whole. Moving along, XLB, really lightweight sector, speaking of weightings, right? So not all that concerned with this one. We know that it was bearish pressure back here as it was breaking to a new lower low, but look at the really slow and steady grind to the downside. If anything, shorts are getting themselves into a corner here, and all it's going to take is one sort of sharp move to the upside. I would imagine if we could take out 79.30, it starts to produce a little bit stronger of a squeeze, and then looking for some sort of lower high up against 80.25. So we're not talking about huge ranges here, obviously, but to do that, once again, counter trend move could be available on our daily time frame spiders. Let's take a look at the communication sector last, but certainly not least. This is the only one hanging on to hope of a weekly balance area. Notice, big time hammer candle. Technically speaking, we closed right at the highs of the prior Tuesday session, supporting off of the equal lows in here is extremely interesting. The weekly chart has not broken down to a downtrend here. It definitely has a lower high, but it does not have a lower low. If we hold on to that 64.25, if we can break over today's hammer candle high at 65.50, I think it's game on for the counter trend to really emerge, starting from the communication sector, noting the slight relative strength without breaking to a lower low today. Here's the sector ratio grid. If you're not familiar with this screen, check out the video tutorial in the top right hand corner on how to set this one up. Overall, I think that it aligns with the opportunity for a counter trend move in the context of a downtrend. I say that because this is neutral in the XLK, the heaviest weight risk on sector. It did not perk up as today saw that rebound into the afternoon session. session. Notice that the XLV, D for defensive, made a move up and over a now upward sloping 50 SMA. Financials have pulled back. They're still more so neutral in this as an overall range, but not doing anything impressive here. And the XLY broke to a new lower low to, I guess it's actually more so an equal low, but right there for almost a new lower low on today's session. That is a look of concern, noting that we're coming from a higher high. The buyers really wanted to produce a higher low if this was going to remain more so a risk-on look. So as of right now, if there's a counter trend move, there's your opportunity for a lower high in the ratio, right? Industrials perked up a little bit. Communications, this is why we're continuing to say, okay, there's decent relative strength there. If a counter trend move is going to really emerge tomorrow, it's probably going to begin with communications taking out the hammer high, and this is a reinforcing reason as to why. Here's utilities rolling over. So this speaks to confusion and volatility. Energy really perking up, outperforming real estate in the gutter, as we saw based on rates continuing in the upward direction. Let's take a look at some specialized ratios. Obviously, with utilities falling off of a cliff, this ratio is going to perk up, but there is an opportunity for a lower high still. And this, once again, being more so neutral, it's not screaming risk on, but it's leaving the door open for a counter trend move as of right now, not suggesting pure deterioration or breakdown. Let's take a look at the XLY over the XLP. Same concept. It's off of its high, clearly just going sideways more so in here, leaving the door open to a counter trend move potentially. Let's move right on into the dollar. We're not going to do a little switch up here on today's session. Moving higher obviously continues to put downward pressure on equities below. The fact that this has just blown straight through the top of the range here, I mean, there was some consolidation, but we never actually experienced a deeper or sharper pullback, means that the dollar is incredibly strong at this particular juncture, and obviously that continues to put downward pressure on equities here. Even if we get a pullback at this point in time, any higher lows over 105.65 are about as bullish as it gets here in the dollar. For a break, retest higher low, that's going to be painful and continue to exhibit pain over in equities underneath. Let's take a quick look at some of the gold contracts, metal contracts, I should say, because we'll look at silver as well. But gold is off substantially underneath these lows. Remember that we were talking about a compression in this overall range, and the fact that it was in an existing downtrend from here to here might have suggested that the break would be to the downside. It did not rotate higher for the quote defensive look into hard assets like metals, and this would speak to the dollar making that move in the upward direction a little bit more plausible, and we can believe into a bullish dollar more so in the circumstances where gold is breaking down aggressively here. Silver has not gone yet, and silver sitting on its breakdown point, its flush point here at this 2280 point is really a threat to me. Like, notice that obviously coming into it we have these daily lower highs. If we slip this, it continues to put upward pressure on the dollar basically, which as we know is sustained downward pressure for equities. So if this gets a little bit of a bounce, if gold sees an oversold rally as well, maybe the dollar pulls back. It speaks to the counter trend move over here, but the overall pattern that's unfolding in dollar and metals right now certainly would suggest a bearish relationship for equities down below. Let's take a look at the TNX breaking out to a new, again, not all-time high, but certainly the highest level that we've seen in a very, very long time. Because we have a higher high, let's just look at this through the lens of technical analysis, right? Obviously, higher lows, higher lows, higher lows, higher lows. Higher high means that we can pull back. Rates can go all the way back down to close this gap, trade around 4.3 in the 10-year, and then see some sort of uptick there off of that and still remain within an overall uptrend. That, I think, is one of the larger dangers. So once again, even if rates cool off a little bit, we get a counter trend move here. All this has to do is catch support off of 4.3 in the 10-year interest rate, right? And we're moving back lower in equities. That's traditionally the relationship, right? Higher rates, lower equities. Let's take a look at the inverted ZT and see what this has to tell us about the potential projections for the tracker tool. And you'll notice that this is attempting, or it's sitting right on the highs in here. If this breaks out, we know that that would increase the odds basically for another hike into the end of 2023. If we actually take a look at the tracker tool, which I have pulled up over here, we'll still notice that there are stronger odds overall for the prolonged pause. And if we are going to get a hike, notice interestingly that we're still pricing in January of 2024. So no more hikes into the end of this year. It seems as though, based on the last FOMC and the updated SEP, which is actually over here, this was really enough pressure for the market to make a move in the downward direction. Jerome Powell has ultimately managed expectations of the market enough via what happened right here to, quote, maybe do his job for him and relieve some of the inflationary pressures from a higher equities market, right? Basically the wealth effect of how people are feeling overall, and the Goldilocks situation of potentially getting a soft landing. He was kind of like, I'm going to walk back my stance on that soft landing, and that's fine. We know that the math works out here to basically provide, again, 4,200. If you want to see exactly how the math is derived, go back and check out last Sunday's episode. If we take a look at the economic calendar here, some honorable mentions. Jay Powell will be on the mic 4 p.m. right at the close on tomorrow's session. Just be aware of that. It will set up a potential move into the following day's session, which of course is Friday, 8:30. We will be getting PCE, so a double market mover as we head into Friday's session. As you trickle on into the office, as I promised on Tuesday's morning live stream, we will have coffee and donuts complimentary here in the office, so make sure to come on out to the show. Let's go back on over to Thinkorswim and take a look at some of our risk appetite indications. TLT for the bond market is up first. What do we see over here? TLT ratio to the S&P is still underneath our resistance trend line here, speaking to, still technically speaking, stronger risk appetite for equities down below. There is no flight to safety unfolding right now. Specifically on today's session, notice that, right there's an ever so slight downtick. And what that would suggest to me is, once again, the counter trend move is potentially one of the higher probability outcomes with this specific rotation taking place, even with the early morning sell-off, right? People were not flooding into bonds saying, oh my goodness, the market's falling apart, I need to go to a safe haven, right? This is countered though, and again, this is the issue with the bond market right now. I think it's a little disjointed if we're making comparisons directly to the S&P, but notice that bonds in short duration continue to tick higher here, which would speak to a lack of confidence the further we go out on the curve, and it speaks to volatility, which is one of the main things that utilities has been signaling as well. If we take a look at credit spreads, interestingly enough, as we discussed in the Sunday update, this was still moving lower into the end of last week. This is the medium duration credit spread. This is the short duration. Short duration continues to uptick, but this is finally starting to make a move as well. We know that this is more concerning because we did actually produce a higher high, and this is still not quite there. Not quite there in the longer duration, not even at the equal. Maybe we're at the equal high from here, but overall, again, shorter duration pain. The market's not really pricing in currently, at least based on credit spreads, longer or medium term duration. It's probably looking at, we're going to see a flash in the pan. There's going to be this big, maybe credit event, capitulation, VIX is going to spike, and then maybe we start to see recovery out of the market. That's what this relationship here between medium time frame and shorter time frame would seemingly suggest to me as of right now. Let's look at the HYG in isolation. Anything from the high yield bonds in their own way. No total confluence and confluence here. Nothing to really write home about from that perspective. What about Bitcoin, the digital gold? Not much to write home about over here either. Continues to stay choppy, extremely choppy in this balance range. Don't get me wrong, it is technically producing some sort of indication for a lower high, but we have not broken to a lower low yet. Let's take a look at some breadth indications here. No stopping on today's video. We are getting a lower low being produced out of new highs versus lows. And, ask yourself the question, is that really a big deal as the market's breaking down? No, it's not providing any edge. There's no divergence here. It would seemingly be exactly as it should be. As the market's breaking down, of course, it's very much more so likely that we're making new lows instead of highs. So that's not really a red flag. Same thing over here with the SPX A200R. This is not technically an oversold zone yet, down around that 20% mark, but it is making a lower low on the week thus far. Let's take a look at the SPX A50R, what's going on with the daily. So this is a daily chart now. This is day for day. What's going on with the 50 SMA of companies in the S&P 500. Small uptick on today's session, and I think that this would align with the weaker internals that we saw, right? If the internals were weak and the market was selling off, right, because that's basically what we saw on that first supporting evidence exhibit A, it would seemingly suggest that maybe the Magnificent Seven, the heaviest tech, cap-weighted stocks, are pressuring the market lower early in the morning, but broadly speaking, things are actually getting better on today's session, and that's also what this would align with. So if that is the case, then it is certainly possible that all it's going to take is a rebound out of Apple potentially tomorrow, Tesla, some of these heavier weighted stocks, right? And next thing you know, the market's seeing a counter trend rally, and this would be supporting evidence of that, basically. Let's take a look at the RSP, what's going on with the equal weight S&P 500. This is waving a big time red flag saying, goodness, look out below. If we take out 140, just a massive divergence. I mean, 140 is the equivalent of down here over on your SPX. We're talking about, 40, 50. Anything underneath that in your RSP is talking about, easily getting there in the first place, which once again, that's kind of in alignment with what we just saw over on the Head and Shoulders projected, forecasted, expected move from the S&P sort of special analysis screen that we were looking at with trend lines, right? So that's your RSP. What about the Dow divergence? It's certainly catching up now. It's playing nicely. This finally made into the early stages of this week a lower low in industrials to play catch up with transport, so not as disjointed as we once were in the past. Let's move along and take a look at volatility, what's going on with the VIX here, and this is where we have to start thinking about credit event and capitulation type sell. We are getting a little bit of rejection, at least on today's session, right? Obviously an inverted hammer there, made a new higher high. We're still suppressed underneath 2050, but all it's going to take is some sort of spike up and over that, and I think we start running over here in volatility. The reason I say that is because if we take a look at the VVIX itself, volatility of the volatility index, this is sitting right on the 103 mark. Remember, in the prior examples, when we were getting up towards that VIX 2050, we didn't really spend any time above. All it's going to take is the VVIX getting here and then seeing a perk up, maybe up and over 120. I think you're looking at a VIX spike and further sell-off, potentially if this stays here first. We see the counter trend, lower high gets set on the daily, this pops, we're looking at a credit event. It's just one possible path forward, but as of right now, seeing this elevated and no longer just playing nicely in the midpoint of this overall range, this is where we're comfortable with volatility. This is a little bit of a threat, opening the door for further downside as of right now. If we look at volatility futures, this would kind of agree with that, making a sharp move up towards backwardation, not in backwardation, still in technically a contango underneath the zero mark, but moving in the upward direction rapidly. Once again, what is that telling you about how the market's pricing in risk as of right now? The market sees quite a bit of risk as volatility futures move towards that zero mark. 9 versus 30-day VIX is inverted already up and over the zero, and 1-day VIX has been in this tight range, not even coming close to any of these lows from down over here. So overall, I think that sure, there might be the opportunity for a counter trend move, but as of right now, a lot of things point to once that counter trend move is made and we see a daily lower high produced, I think we're in store for continued downside. QQQ daily time frame chart did produce a bar-to-bar lower low, but perhaps the most important takeaway is the weekly lower low that was produced in today's breakdown. So that lower low ultimately ushers in a weekly downtrend, which is important because as of last week's close, the S&P was in a weekly downtrend, but the Nasdaq certainly was not, with this offering the potential, obviously it broke down, but the potential for some sort of higher low, equal low inside of the weekly range. So that's noteworthy. It doesn't change the fact, though, that just like the S&P, we do have ourselves a daily hammer candle, which finds support on a long lower wick off of a prior level at 352, closes back in the midpoint of the previous day's range, and the shorts start to get a little bit of pressure applied if we make a move up and over 357.75. If we get any sort of move in the upward direction, the clear target would be the upper bound of the two-day balance from the Thursday and Friday, around 361.50. On an hourly time frame chart, you would be much more concerned with trading for this range here in the first place up towards 357.75. We'll see that now, actually, if we take a look, right, the bottom end of the overhead balance, that's the two-day balance basically, and you could include somewhat of Monday's activity as well in there. All the consolidation from the afternoon was above. So if, again, let's just rewind the tape actually. If this is going to become a look below and fail, right, technically the target should be the top end of the range, and with that bullish consolidation into the afternoon, it was looking pretty good if the buyers could have opened up above that level into Tuesday's session. When we open underneath the consolidation, again, it's no surprise that the market sees a little bit of a move lower, and today, opening inside of that consolidation, once again, gives and keeps the bears content, so they still have the upper hand in the context of an existing downtrend. This is where things get shaky though, right? If we can take out this level here at 355.65 with an hourly close above, that's where you get that rotation into the bottom of the two-day balance range at 357.75, and then the stronger daily target is if we get acceptance in there, boom, you're looking at the bottom of the gap at 361.50. The gap closes ultimately at 364.75. Daily lower highs can be set here, and daily lower highs can be set on the gap fill reversal as well. Any further consolidation in this area really just sets up bear flag on a higher time frame or the potential for a new balance to form, something that looks like this, right? We're building out value lower. If we just go sideways in this range, it's really not pretty for the buyers. You ultimately want to open, let's go down to a 5-minute chart, just like we did in the S&P. You ultimately want to open somewhere above, let's see, 354.25. If we can open above 354.25 in the QQQ, I think it increases the odds that these shorts are like, oh my goodness, why did this breakdown not materialize? Once again, we're looking for that squeeze on hourly closes up and over 355.65. If it's early on in the morning session, you're looking for a higher low above, and then you're going to look for that rotation, 357.75, as we were just referring to. Consolidation in here is very sloppy for all of the reasons we just discussed. You're going to have people jockeying for position in this box. If we do take out that low at 354.25, looking looking left, there's incredibly thin structure. Granted, this is a 5-minute time frame chart, but if we break down through that, I mean, it's not unreasonable to tag the lows. And once again, maybe we build out some sort of balance here, which sets up over time some sort of next move here or here outside of an established range. Let's take a look at the Nasdaq internals. We'll notice the same story as the S&P internals. So really brutal day on Tuesday, and Tuesday over here. Today, not so much, right? With the rebound in the breadth readings, the rebound off of the zero line, and the cumulative tick, which is really not bad at all. So it speaks to a concentrated number of stocks ultimately producing the downside early on in the day's session and into the afternoon. It's the reprieve rally with the understanding that throughout the duration of the morning session, this is just, again, let's just say 10 stocks moving lower, the heaviest weighted components, and everything else is moving higher. It's much easier when those 10 stocks find a little bit of a relief rally to see something like this into the end of day. So the stronger base is being reflected here as well over on the Nasdaq side of the market. Let's take a brief look at the market profile. Anything to write home about over here? Not really. I think that this aligns with the consolidation and sort of neutral look that we were just outlining inside of and above that 354.25 level over on the Qs, right? That's ultimately just chopping around in the 2-day value area at this point in time. Value was slightly lower here. Remember that the S&P had equal value, or excuse me, I should say point of control. The point of control was equal and the value area was more so equal as well. Notice that you have a more severe lower low out of the value area low on today's session. Still not getting a lot of volume commitment at these lows. So once again, I think that the door is open if we can take out the 2-day high for something that's a little bit more impressive to squeeze out any shorts who are initiating here and did not get paid on today's session. We did repair the poor low and we do have a little bit of excess there, much more so meaningful excess over on the S&P. But as I zoom in on this just a little bit, you can see that we definitely have a couple of ticks of excess down below. So that is a firm low as of right now. Here's the SMH semis ETF just as supporting evidence for our QQQ. I would be patient on QQQ longs until we can get a break and higher low up and over SMH 143.40. That would certainly act as supporting evidence. It would help build confidence in the bull case if that is going to unfold. I do like the daily bar setup that has unfolded here, making a new lower low and then closing in the midpoint of this consolidation. If we can take out 143.40, that certainly would be constructive once again for a stronger long in the QQQ. If this just wants to chop around down below, I would say that the stronger long is probably looking at your S&P 500. IWM Russell 2000 and the small caps daily time frame chart. Clearly, this chart is struggling. Now, it is going sideways down here at the lows, and as long as it continues to go sideways, it does not continue to move in the downward direction. It would support the idea that maybe we can see a counter trend move in the S&P and the Nasdaq markets. But if we do see a continued downside move out of the IWM, if we break from today's inside bar in the downward direction, that would put a damper on the sort of rally, counter trend rally attempt that we're looking for in the spiders and the Qs, for example. Even if this does rally here with the broad market, the S&P and the Nasdaq as a whole, remember that we're not constructive at all by any stretch of the imagination on the IWM and small caps as long as we're underneath 183. So even if this sees an outsized rally into the end of this week, there's too strong of an opportunity for a weekly lower high somewhere in here, which, as we know, keeps us in sort of a terrible range on small caps. And just, the lack of participation, we've had this conversation a number of times now, but there's nothing constructive to say about small caps as we're trading underneath 183. We're just underneath the midpoint of the weekly range. It's very difficult to be a broad market bull when we're trading in this overall area here. If we take a look at the hourly time frame chart, let's go on over to an hourly. How about an hourly? Let's get an hourly. There we go. On an hourly time frame chart, what we'll notice over here is that this is the inside bar clearly. And if we can take out the top, you're just looking for a rotation to the top of the prior range and the bottom of the overhead gap. 178.75, 179.80 is the gap close. I would say that it could be a likely scenario as long as we open over the Tuesday opening print, which is at 175.52. So using that same sort of psychological analysis that we performed on the S&Ps and Nasdaq, the sellers who initiated here for the breakdown on Tuesday are like, okay, what's going on? If we're opening here, there's the potential threat for something that does this into the end of this week. If the IWM can get a higher low over 176.60, that would certainly be constructive for the overall broad market counter trend rally that we've been outlining in today's episode of the Midweek Market Update. Let's take a look at the market internals for the Russell. Clearly, again, you get your bearish Tuesday across the board, and today, not so bad in the Russell as well. Out of the market internals, not much to write home about there, considering that today was an inside day and we did not technically break to a new lower low. Let's take a look at the Russell futures through the lens of market profile. Then we'll jump through our core list of companies. Progress made considering that the value area was definitively higher on today's session, as was the point of control. So once again, is it possible that we could come up and actually look at this extremely poor high from the Monday session, mechanical because we have Tuesday's high there as well, and today very, pretty much spot on. Let's not split hairs here. It's a very mechanical level. If we can get over 1804 in the Russell futures, that would certainly set up once again your constructive look for the broad market to make a counter trend move. Apple is up first for the core list of companies, and what we'll notice is that we have day 2 of a balance range breakdown. And what else do we know about balance range breakdowns? We're typically looking to double the balance range. Notice day 2, and we're at the target, ultimately, the lower bound of an extension of the range. So the interesting thing that I find about this is that, well, it's really a combination of 3 things. Number 1, it's day 2 of the breakdown. Typically, that's a good time to start booking some profits on a trade. Number 2 is that it is a move into the gap here, right? This is a prior earnings cycle gap, and we didn't find stronger sellers who are willing to close that gap all the way. So I'll put G here for number 2. And number 3, as we pointed out, we are home basically at the forecasted target, the measured move from the breakdown of the balance range. Now, it's not fine and dandy in Apple because obviously the threat now is that any counter trend move here sets up a clear lower high reattempt at 174. Here it is on the hourly time frame chart. As we zoom in, again, look at, and the daily bar was not as impressive as the S&P or the QQQ or anything like that. We did not make a rotation to close back within the Tuesday consolidation before the break. So none of that is going on. But even if we do get a counter trend move, right, you're looking for a lower high here, or you're looking for a lower high over here. There's no indication on Apple as to where that potential squeeze is. The bears are more firmly controlled in the heaviest weighted stock in both the S&P and the Nasdaq as of right now. This is one of the reasons as to why the morning breakdown was so aggressive, and when it flattened out into the afternoon, we were able to get a little bit of a rally higher. Let's take a look at Netflix. This is an hourly time frame chart. Again, there's not much to discuss about Netflix, especially when we flip back to the daily, noticing that it looks something like this. I mean, do you want to be a new money short down here? You can be my guest, but I'm going to pass on this setup 10 out of 10 times. If we take a look at the hourly time frame chart and zoom in, the only time that maybe something interesting happens over here is if we get, maybe there's an indication for some sort of inverted head and shoulders and we finally produce a counter trend move. Even at that, I also, I'm not trying to catch a falling knife if the price action is looking like this. We're starting to, slow down this pace of selling, but I'm not seeing any clear setups right now in Netflix that would warrant, an idea and further discussion. Here's Tesla finding a little bit of support off the midpoint of our prior range from down below. Let's take a look in the hourly time frame chart. And what you'll notice is this was one of the culprits that produced that strong rally into the afternoon. Now, unfortunately, if you're a stronger bull or if you're a market bull looking for the market to move higher, there's pretty decent odds of a lower high being produced underneath 243, right? We broke to a lower low out of this consolidation. There's a back test of overhead supply. Anybody who is looking for a long here for the break out of the range has the opportunity to sell for break even. Do you think they're going to take it? In my eyes, noting that the market's in a really tough spot right now as a whole, the broad market, I would seemingly think yes, right? The nature of markets right now is definitely more so for a downtrend. So looking for the opportunity of a lower high at 243 to flip long, I would want to see a higher low over 247 to make these buyers whole again. Next up, we have Google. What's going on with Google? This was the Uno reverse card from this morning's session. If you tuned into the live stream, you know exactly what I'm talking about, but we opened above this afternoon consolidation from the Tuesday breakdown, squeezed out the shorts through the thin structure, just absolutely beautiful. Now, just like Tesla, we do have to contend with the possibility of a lower high around this area. So the long trade has played out. Overall, we are in a downtrend. It's worth acknowledging that this was a scalp only, and you shouldn't really be thinking about new longs at the base of this range, right? This is a back test for a potential hourly lower high. So I'd be changing the tone now on Google. If tomorrow's going to be a down day in the market, Google looks like a strong opportunity for a structural lower high. If tomorrow's an up day in the market, I would look for chop through this range, and therefore it's not really all that attractive on a long-sided idea. Next up is Metaverse. What's going on with Zuckerberg's Fantasyland? This is still an hourly time frame chart, folks. Look at the volatility. Again, almost like Netflix, it's a hard pass for me. We talked about the volatility over here. We talked about, hey, maybe it's starting to, respect some structure. Today, the card has been revoked again. No interest in trading Meta if it's going to continue to produce outcomes that look like this. I don't care if someone made $1 million, $10 million, $100 million. That type of risk is just not worth it for my trading style. So if it floats your boat, be my guest. But for me, I'm going to take a pass, and therefore my analysis is, if I'm not going to have skin in the game, it's not worth, providing you my thoughts there. So NVIDIA, what do we see over here? Certainly the opportunity for a flag breakdown if we can move through this trend line, right? So watching this as bear flag consolidation, sure, the price acceptance has been interesting over the 419.25, but let's not forget that we're in an overall downtrend, right? This has the opportunity to act as a lower high up against 432. So once again, if the market's falling over tomorrow, meaning making a move in the downward direction, I'd be watching for a trend line break out of NVIDIA, something that might do this, might get back down underneath 419.25, probably favoring more so the horizontal level. That's usually what we watch for anyhow. Or if we do rally, if the broad market rallies, I'd be looking for, does NVIDIA participate all the way, or does it lose steam at 432? If it loses steam here as the broad market's ripping to the upside on a counter trend move, that's a pretty big giveaway that there's relative weakness, and you should be looking for any excuse to go short on a lower high when the broad market starts to roll back over for some potential continuation of the downtrend. Next up, Microsoft. What's going on over here? Here's a daily time frame chart. This was also had the opportunity for an Uno reverse card here. Didn't really pan out. We didn't open close enough to being over that range. We didn't get the squeeze. More so just consolidation down here. If we go back to a daily time frame chart, I want to illustrate that 312 is a very important level from back here, right? It was a prior low. Even if I scrunch it up, it was a prior low from over here as well. Back to the hourly, notice that we tried to get bearish acceptance underneath, and today we actually closed above. So the Uno reverse card could be pulled out tomorrow. The issue is, though, that you're only looking, like, there's minimal range overhead now. You're not going to trade for like over the high there for, I don't know, a small move into 315. The better look now would be some sort of higher low here to produce, I know it's very sloppy, but bear with me, some sort of inverted head and shoulders. Maybe there's a reversal if we can go higher low over that 315. If we're underneath it, there's still too much of an opportunity for sellers to step back on the gas pedal. Next up, last but certainly not least, we've got the mini beast. Here is Amazon. Here's the daily time frame chart, just to give you an idea of where we're trading at in terms of prior consolidation, prior chop. Do these levels look easy to you? There's not thin structure back here. There's quite a bit of volume that was conducted in these areas, right? So this is not particularly an easy chart to the downside as we're chopping around in the midpoint of those prior ranges. I just want to mention that because technically speaking, if we go to the hourly, there's still an opportunity here for a lower high, right? There's either a lower high here or there's a lower high for something that does this. How aggressive you want to be on those lower highs, that's not really, that's the reference from the daily, right? It wouldn't really make sense that big new money shorts are going to be the easiest thing to trade through this range from the past, right? We have all of these levels stacked, lows right here, lows right here, right? The better move would be, okay, through this thin structure breakdown back to these prior lows. Obviously, that's a huge stretch of the imagination for something that does this. So on Amazon, we closed back within the Tuesday range, just like what we talked about in the S&P and the QQQ, really. So closing back within the previous range after making a lower low leaves the door open for a potential higher low above 126.25 for a counter trend, and then I would look for, again, your daily lower high to continue your overall downtrend on the back test of the bottom of your prior range from over here. With that said, let's move into one additional trade idea. No break, no cut, no nothing. AMDizzle. Honorable mention to AMD. Aren't you glad you made it until the very end of today's episode? Because here it is. AMD produced this little balance range that's squeezed between a set of highs and our daily 200 SMA, which is clearly upsloping. So if we take a look at the hourly time frame chart, let's zoom real tight on this thing. There you go. We've already experienced look below and fail. Technically, you might consider this upper wick look above and fail, but I would be willing to give it the benefit of the doubt with the close stronger towards the upper bound of this overall range. If tomorrow morning we can get a higher low over 98.60, looking for the first target as your gap close, that's going to be at $100.30, and then beyond that, your next major target would be 102.65. That is if the broad market as a whole is making its counter trend move in the first place. If the broad market is really struggling tomorrow, I might start to think about, okay, if we get here and then come back into range, you know the deal. That's a look above and fail target. The bottom end, that would be at 95.83. That's all for today's episode of the Midweek Market Update. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a thumbs up. I went a little bit quicker through our supporting evidence. Let me know how you feel about that format. No breaks, no cuts. I think it was quicker. Maybe it wasn't. I'll determine based on the total length of today's video. I'm going to stop talking. I hope to see you in tomorrow's episode of the Pre-Market Prep, kicking off at 8:15. And with that said, I wish you a green trading week.